The Great Depression. In this video, we will examine the causes and effects of the worst depression in our nation's history. The causes of the Great Depression. After the economic boom of the 1920s, the economy collapsed at the end of the decade, causing widespread unemployment and a sharp fall in prices. There were already many structural weaknesses in the economy, and the New York stock market crash in October 1929 would set off a chain reaction that ultimately toppled the American economy and soon spread to the rest of the world. Production surplus. The most evident economic weakness was the huge production surplus. A surplus is an excessive amount of production that is not sold. Industry had expanded quickly with cars and new appliances. But by the end of the 1920s, everyone who could afford these products had already bought them. Wealth was concentrated in a small group, and the average American had no purchasing power to buy many of these items. Soon, inventories of unsold products piled up, forcing stores to close and factories to stop production. As production came to a halt, many workers lost their jobs, causing a sharp rise in unemployment. Restricted international trade. You may recall that during the 1920s, the Fordney-McCumber Act had established higher tariffs to protect American industry. The measure ended up hurting international trade, as many of our trading partners began retaliating by setting up their own tariffs against American products. This ultimately meant that the U.S. could not sell their production surpluses abroad. To make matters worse, after the stock market crash, Congress passed the Smoot-Hawley tariff, the highest tariff of all, which intended again to protect American producers, but ended up hurting international trade even more. Speculation. During the 1920s, the growing speculation went largely unregulated by the government. Investors were in a frenzy to buy real estate, stocks, or anything else they could sell later for profit. Banks were placing their depositors' money in risky and unsound investments, and even lending money to stock market speculators. Stock purchasers were buying on margin, putting only 10% down and borrowing the other 90%. This strategy worked well in a bull market, a stock market in which share prices are constantly rising. With widespread speculation and the overextension of credit, the economy was structurally unstable and vulnerable to a shock. As soon as the stock market slowed down and stock prices began to fall, a financial crisis of unprecedented proportions was unleashed. The stock market crash of 1929. By 1928, the economy was already showing signs of a slowdown. The election of Herbert Hoover at the end of the year gave investors confidence for 4 more years of Republican prosperity. Stock prices picked up and continued to rise for a while. Then, in October of 1929, the market suddenly slowed down and stock prices began to fall. On Black Tuesday, October 29th, the stock market crashed. Corporate and private investors had rushed to try and sell their stocks at a time when no one was willing to buy. In a matter of 3 weeks, stocks lost up to half of their value, and $30 billion simply vanished. The market crash set off a chain reaction that would lead the economy on a vicious downward spiral. Corporations were no longer able to raise funds, and business prospects were gloomy. As many as 26,000 businesses failed in 1930. Unemployment rose sharply. Banks also began to fail as investments failed, and loans remained unpaid. Many Americans ended up losing their entire life savings and property. Additionally, demand for goods decreased, bringing prices down and deepening the Depression. As American banks started calling their debts in Europe, and the Smoot-Hawley tariff came into effect, the Depression quickly spread from the United States to Europe and the rest of the world. The human dimension of the Depression. With the Depression, tens of thousands of businesses failed. 500,000 farmers lost their land, about a quarter of banks failed, and more than 10 million Americans lost their jobs. At the time, there was no safety net or federal programs to deal with unemployment, retirement, or ensuring bank deposits. Americans who had worked hard all their lives soon found themselves losing their job, their savings, their homes, and living on the streets or in improvised shanty towns. Malnutrition was widespread, and many people depended on charity, soup kitchens, or bread lines to feed themselves. Farmers, coal miners, the elderly, African Americans, and other minorities were already facing difficulties during the times of prosperity and were especially hit by the Depression. President Hoover's response. President Hoover, just like his Republican predecessors, was following a laissez-faire approach, and his economic advisors recommended not to interfere with the economy. To them, it was just a matter of time for the economy to reactivate itself. Low prices would make people resume consumption, and production would be restarted soon, bringing unemployment down. The economy, however, continued to deteriorate, and the Depression was worse month by month, with no improvement in sight. Hoover was a firm believer in rugged individualism and firmly opposed offering federal aid or interfering with the economy. In his mind, Americans had to deal with the Depression with strength and resourcefulness. Offering federal aid would only weaken their individual character and reduce the incentive to work hard. Eventually, Hoover reluctantly took some steps to fight the economic downturn, but it was too little, too late. Initially, Hoover resorted to voluntary action and asked business leaders to not lay off workers. Fiscally, he cut taxes and increased federal spending on public work projects like Hoover Dam. He also established the Federal Farm Board to buy agricultural surplus from farmers. By 1932, it was clear that the economy was not responding to Hoover's timid efforts, and further measures were needed. Hoover established the Reconstruction Finance Corporation, which gave emergency loans to banks and businesses. By doing this, Hoover believed that the economic benefits would trickle down to average Americans, as banks and corporations expanded once more and started hiring. Only $2 billion were lent under this program, a small amount considering that losses in the stock market alone amounted to $40 billion. The measure was inadequate to cope with the magnitude of the problem, and to make matters worse, the Federal Reserve decided to reduce the money supply. With less money circulating in the US, the economy deteriorated even more. Public frustration. Americans were frustrated with Hoover's lack of leadership and his inability to deal with the crisis. Soon, the name Hoover was used to describe many of the negative aspects of the Depression. For instance, newspapers were often called Hoover blankets, and Hoover flags were nothing but empty pockets turned inside out. The shanty towns that began to spring up outside major cities also took his name, and were called Hoovervilles. Demonstrations against the government were frequent, but one protest in particular received lots of attention. Unemployed veterans from the American Expeditionary Force that served in World War I had camped out with their families in Washington, D.C. in the summer of 1932. They had come to the nation's capital to demand payment on a promised bonus that hadn't been paid. Fearing a possible riot, Hoover called on the army to disperse the so-called bonus expeditionary force, or bonus army. Many were shocked at this action against America's veterans, and Hoover's unpopularity grew. In November 1932, Hoover ran for re-election and lost by a landslide. Franklin D. Roosevelt was elected as president, with his promise of a New Deal for America. In the next video, we will explore Franklin Roosevelt's presidency and the New Deal.